Monetary policy around the world has been really loose since 2009. Obvious reasons. No central banker wanted to risk the type of depression that happened in the States after the banking collapse of 1929. And so we've had very low interest rates, and we've had central banks buying up bonds of their governments to drive down long-term interest rates. And we've all benefited from it. Car loans are ridiculously low with regard to APRs. Mortgages, if you can get them, because the lending criteria is tightened up, are actually fairly cheap. And this has enabled, or the central bankers would argue, that this has pushed back against the consequences of a global financial crash, which had the potential to drive the global economy into a nasty depression. But growth has been around for a long time now. It's running just about an above trend in the US. Germany is beginning to power forward, as is Northern Central Europe. Japan has been fighting against its deflationary forces, and although China is slowing down, it's still a major force for future economic growth. Arguably, leaving on financial stimulus for much longer could be detrimental to inflation, and that point has not been missed by the Bank of England or the ECB or the Fed, all of whom have talked about raising interest rates into the future. Our view is that eventually this is really bad for bonds, which is why we have not been buying long-dated bonds of any description.